Let me share a story with you about my time with the venture capitalists during the dot-com bubble. I'm Justin Hitt with Sustainable Wealth Secrets. There is a function called ratcheting that is used by venture capitalists and a lot of investors in order to get the maximum amount of money out of the marketplace to pay off the initial investors. Let me explain. So, first off, I'm on LinkedIn, and Scott Allen, author of a number of books on social media and expert in his field, uh, posts a post about the bubble you don't know about. So, we're talking about Bitcoin here, and he shows what is a 5 to 10 year trend of Bitcoin against the US dollar. So there's an important measure that we use in finance and building wealth is where you compare your currency against some other currency or some other fixed asset, and that way you can see the relative price. And what he's showing here is Bitcoin's price in US dollars over time, and you're going to see these little peaks. So the price goes up, it peaks, and then it drops back down, and then it goes up again and peaks, it drops back down. It keeps doing that over, say, a 3 to 5 year period. The S&P 500 does the same thing. And what that is actually called is ratcheting. It's where the price goes up. There's a lot of hype. There's a lot of talk about, will this hit the new price high? And then after a certain number of people get into the market, either the professional investors short out, meaning they start setting up. Either you can do it with futures, you can do a lot of other things, but they kind of set up a gamble on the price going down, and again, they're doing math. They're not doing this by emotion. The marketplace by emotion is running the price up of the stock or the Bitcoin or whatever it is. But the investors are measuring and monitoring that, and they'll see a trigger, and that's when they come in and put their shorts in because they know the price is going to come down. All the people who can buy into something will stop buying in. The velocity will slow down. People get scared, and then folks start taking profits. When folks start taking profits, the price of the item, Bitcoin in this case, will start going down. Now, I don't know that you can short Bitcoin. There are derivative markets, but ultimately the price goes down. And then the folks who are investing will either buy more or they'll know to hold in order to get the next peak to sell out. So the way this works with venture capitalists, and believe me, this is what I used to do as a consultant. I would migrate data centers, and during the .com uh, build up, venture capitalists would buy out like software companies, hosting companies. I worked on the PSI Net and the Digital Nation buyouts. Um, they essentially wanted to buy it at $1 and sell it at $5. They wanted a 5 times return on whatever they did. And so they were very calculated. And I was fascinated about the math. I was fascinated about the approach. But what they're doing is they're monitoring human behavior. They don't create these peaks and valleys. So if you look at the S&P 500 over 5 years, you see these peaks and valleys. Um, because they were able to get in early, they had the wealth, they had the money, they were able to raise money to buy early. They can actually, at each of these peaks, sell off, which triggers the dumping of the stock, dumping of the Bitcoin. And then when the price drops down again, they can buy it at below their cost basis. And then now they're able to buy it at the cost basis. They're going to continue to buy more, doing dollar cost averaging. And then when it peaks out again, they'll trigger the peak, and they're not necessarily triggering the peak. This is human behavior. When the price gets too high, a lot of people who need the money are going to sell, and then that snowballs because people will lose confidence in the market. How do we use this? Well, I have formulated a system. So, one of the things about working with the venture capitalists, one of the things about interviewing multimillionaires and billionaires, um, I've interviewed more multimillionaires than I have billionaires. I think I've only gotten 2 billionaires in the last 20 some years I've been doing this. But here's my point. It's not about the emotions of the market, whether it's Bitcoin, .com companies, whether it is mortgages, everything goes up will come down. So as it's going up, there's nothing wrong with dollar cost averaging, buying into the gain, or maintaining a clear measure of your cost basis and buying additional shares anytime the price is below your cost basis, so that you're essentially bringing down your cost basis. But they're not competing with the market. They are promoting the market. This is very important to remember. They're buying, securing their shares on whatever the next trend is. They're doing it right now. These venture capitalists are professional investors. They sit around all day trying to figure out what the next thing is. They buy 5 or 10 of the next thing, and they do math and figure out which of those things are most likely to grow if promoted, and then they go out and promote. They do the marketing. So I was supporting the technical development, and over time I moved into the marketing side or the business development side. Some of these technologies will develop just fine. What you'll notice over time is there used to be a handheld flat screen phone, the Palm Pilot, and it did well for a few years and then it failed out. But the iPhone, which is essentially pretty much the same thing when it started, actually had great traction. So there's a lot of times the personality of the people that you're putting out front, the willingness of the audience itself to buy the product, the acceptance of a concept or idea. So Bitcoin, there was a distrust in governments and there was a desire for currency that can move across borders, so a borderless currency that also had theft protections in it. And so the Bitcoin was a secured wallet. The blockchain is a secure environment. And so there's also the fascination with new technology. So Bitcoin was the thing of its time, but all things of their time will eventually bubble before they are either accepted as the norm or they are just regulated out of existence. There have been personal computers before, the personal computers 1980s, um, but it didn't get widely accepted a computer in every home until the 90s or so. My point again being is that whatever goes up will come down. So you need a mathematical way that looks at your returns to get into an investment position and then have a clear picture of how you're going to get out of that position. So when you buy, what price are you going to sell? And so what they taught me is that you decide up front how much you're going to take off the table. So in my case, it's 25% on a stock investment. So I'm investing in stocks, I'm S&P 500, whatever. When I'm at 25% returns, I'm going to take some money off the table. And we did this in the silver bubble. We did this in the mortgage bubble. We did this in a lot of bubbles. It tends to get you above average returns. And of course, I've got a program on this so I can go into more detail. But the gist of it is because you're taking a little bit of money off the table, you're not getting emotionally attached to it. Now, when you take money off the table, what do you do with it? Well, if you take money off the table at $25 a share, and now the shares are at $5 a share for some reason, you didn't lose as much in your holdings, but you can re enter if at the point of re entry, that particular investment has value over top of all other possible investments that are available to you. So, from the balanced portfolio perspective, where you have equities, bonds, and perhaps an alternative type of investment, what you're essentially doing is when the equities are inflated due to hype in the marketplace, due to general public sentiment, a lot of dumb money going into the market, could be due to regulatory changes. It doesn't really matter what it's due to. If it is over its value, you can then take a little bit off the table there and put it into something that has then devalued because even the bonds go up, they'll come down. If they come down, they eventually go up. But again, it doesn't mean they can go to zero, like they all can go to zero. Bitcoin can be found out as a giant Ponzi scheme and get shut down, and everybody lose everything. Um, a big company, so there are actual scams that can go up and up and up and then go down to zero and never come back up. There's also the possibility in a lot of industries that when it goes to zero, it stays at zero for a time period that's longer than you need money for. So again, this is not an advocacy for like buying and holding forever. It's about measuring your cost basis. It's about buying into quality investments when they are at a high value. So you're buying a $100 company at a $50 price. You're buying it when it goes on sale. And to understand that there's a human behavior element that causes things to go up and down and not to get sucked into that hype, not to get sucked into that excitement. So these were, I was hanging out with these venture capitalists. They aren't bad people, but they had figured out the human behavior element the investment element, and the promotional element. Now, what was interesting about the venture capitalist world is they would go out and build a portfolio on paper. They would go pitch the portfolio to investors, a lot of times institutional investors, hedge funds, all kinds of different companies, wealthy individuals and wealthy families. And then they would syndicate the money from these investors into this portfolio and then use this management on this portfolio. So in many cases, the investors, the venture capitalist money wasn't even their own money. And then what they'll do is at a point is they'll build up a phase to an IPO. So the initial investors will cash out some of their chips, and they would call them. There was a lot of casino jargon, but they would cash out some of their shares at the IPO, and then the hype or the promotion in the marketplace, which is sometimes the responsibility of the venture capitalists. Sometimes they hire public relations firms or marketers. Um, that hype would bring the price up again after the IPO, and then that second round of investors, that third round of investors are actually cashing out previous rounds of investors. And then by the time it is a publicly traded stock, the venture capitalist firm, their hedge funds, their uh, people who have benefited from this investment scheme are now into the next thing. So it's not, it's kind of a long term pump and dump, but there are definitely bubbles that you don't see. And the way you start to see them is again, look at your own cost basis. Make sure you're buying quality investments at a good price. You want to make sure that you have multiple streams of income because the cash flow matters more than what the paper says it's worth. So you buy a stock at $1 and it's worth $10 now. It doesn't actually mean it's $10 because you have no cash flow in there. It's just that's what they say on paper. Now you can sell it, and now it's worth $10, but you can also buy more because based on the numbers, it could be worth 100 in a short period of time. There's also a factor, by the way, too, that I hear people saying. Consumer investors will say, "I didn't lose money till I sell it," because the the way it works is it's if it's increased in value, it's not actually worth. It's always worth your cost basis. That's how much cash you put out. But if the price goes up, it's still worth your cost basis until you sell. But if the price goes down, you've actually lost money. You've lost buying power in your original cost basis. So if the price has gone down, it really has lost money, even though you haven't realized those losses. Now, of course, if you're realizing those losses in one area to offset the profits in another area, that's tax harvesting or loss harvesting. That's a different story. We could talk about that some other time. But again, these predictable peaks and valleys happen due to hype in the marketplace, due to human behavior, and they are demonstrative of movements based on your portfolio. So if you got in at the second phase of an IPO, you may not get any money. You just basically cashed out the previous people. They got their predetermined amount of return. They're happy. They're moving on to the next thing. Now, what you want to look for though is when they second round it and the original investors double down or put more money into it. That's a good sign. But ultimately, don't be surprised if Bitcoin crashes, if the stock market crashes, if there's economic distress, because something else will come along. What you need to make sure, though, is that on paper, your net worth is growing and that you have free positive net cash flow because you need that positive net cash flow to stay in the game. If the stock drops and you've done the numbers and you believe it's a good investment, it's a quality investment, and it's just on sale because of bad news in the marketplace, but you don't have any cash to buy additional, then you're actually in a bad position. You did all that research and you got no dry powder to do anything with. So again, um, there are things that matter more, and these venture capitalists they did sit around and talk about this stuff, and I was there because a lot of times what my goal was is to go in and inventory their equipment and find out if they got really good equipment because you want to keep the good equipment, but then also spec out in the new environment what other equipment we need to kind of like triple capacity or quadruple capacity, but equipment that was generic to the underlying platforms. So in the case of a data center migration, they would buy up a couple like internet services providers, hosting companies, combine them onto a newer platform with more capacity, then layer on top of that their .com clients. So they'd have their portfolio in there. So essentially they have zero cost of hosting. And then we would lease out the surplus capacity to consumers who had the same dream about being recognized as the new .com prodigy, who would pay exorbitant rates to basically make hosting free again. And then finally, if the .com companies crashed, the underlying infrastructure was so generic that the company could just keep going. It didn't, it could just put, if a medical.com company failed, they could put a shopping.com company on, or they could split it up and sell it to 1,000 different nonprofits. I thought it was fascinating. I thought I'd share this story with you. If you have specific questions about how these investors will cash out, and how you can use this methodology. Because again, I am not encouraging you to get in on the ground floor and to get in as a venture capitalist. Because some of these folks, the venture capitalists always made money. It was by design, but some of the investors walked away with nothing. Um, they they ended up losing everything they had. Um, Now, if you use this strategy with an S&P 500 in a bond portfolio, the balanced portfolio we've talked about in the past, then you're going to be just fine. But understand that you're in a place with professional investors. Venture capitalists go to school, study economics. They they have insider knowledge and skills that you may not be able to acquire in your lifetime without constant and regular interaction with these folks. I interacted with them for 5, 6 years, and I still don't understand everything they're doing. In fact, I took a college level private placement class so that I could understand some of the investment side of what they were doing, and because that was part of a joint venture that we worked on. And after those months, and after some finance classes, and after some economy classes, I do understand what they're doing, and I hope I've shared it with you in a relatively easy to understand concept. But if you have questions, visit me at www.sustainablewealthsecrets.com and look out for the bubbles. It's a human behavior. There isn't any conspiracy that they're pumping and dumping. It's just that's how it works. A bunch of people pile on to whatever the newest thing is. They don't know what they're doing. They got big dreams of cashing out big money, and then ultimately the initial investors cash out, which triggers the market to dump. The market dumps, and you're stuck holding the bag if you aren't paying attention to what I've shared here today. Thanks for listening. I'll see you in the next podcast. I'm Justin Hitt with Sustainable Wealth Secrets, where we help you transform your income into net worth and prosperity.